Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder from Seeking Alpha. Welcome to another ETF Spotlight. Today we are jumping into conversation with Taylor Ranney. He is from Rex Financial. He's a senior vice president over there. And we're going to talk about FEPI ETF. Now that is the Rex FANG and Innovation Equity Premium Income ETF. Well, let's dive into the strategy, shall we? So Taylor, thank you so much for giving us the time today to talk to you.
Yeah, pleasure to be here. Excited to talk about FEPI.
FEPI it is. So let's dive in. The strategy. Can you give us a brief rundown and maybe how the fund came about and what this specific strategy is behind the tech kind of focus that it has?
Yeah, of course. So the covered call ETF space is still somewhat of a newer asset class. 5-6 years ago, there were a couple $1 billion within this space. And today there's probably 150 billion. I know that number changes pretty dramatically on a day-to-day basis at this point. But one of the benefits of kind of a newer asset class is that innovation and evolution continue to be at the forefront of product development. And so not being first to market with a strategy gives you an opportunity to look at what other strategies have done and maybe how you could optimize or change or differentiate yourself. And so if you look at majority of the larger ETFs within the space, a lot of them write on the index level, their options, right? What we decided to do was create a strategy that writes on individual securities. And so, the primary reason we went with the tech universe is because there are higher implied volatility names on those underlying securities. And if you look at implied volatility being the primary driver of premium capture within a covered call ETF, you kind of start to realize that there is a nonlinear relationship between implied volatility and the estimated premium that you can collect. And all I mean by that is the higher the implied volatility, you get an outsized contribution from premium that you're collecting, right? So you still have diversification benefits within this type of strategy. And that's really important with this type of strategy to A, be able to participate in tech rallies, and B, be able to recover NAV if there's a downside or drawdown event, right? So the combination of those become incredibly powerful because with FEPI, we're distributing on an annualized basis 25.2% roughly. And we've hit 2.1% per month since launch. And so you really need to be able to participate on the upside within those strategies. So tech naturally is a really good fit for that type of more concentrated portfolio to achieve that goal.
Now, traditionally, people have kind of thought about the tech space and we think about growth, right? Because I mean, tech over the last couple of decades has been just a gangbuster of a place to get capital appreciation. But now you're here focusing on this income. You're selling these covered calls over and kind of capping the upside a little bit. So how does this work in balance? Should people be thinking about the growth aspect, or is this more solely focusing on the income play?
Yeah, I think with all of these strategies, you have to think about it within a total return context. Otherwise, you could have this really nice looking distribution yield or rate. But if your NAV is falling off, then that rate on a dollar basis is declining, right? So you have to continually think about it from a total return perspective. But this portfolio certainly is focused on income, right? It's 100% covered. We rebalance on a monthly basis. We reconstitute the portfolio quarterly, so it does follow an index methodology. But that's part of the benefit. And that's also, like I said, the importance of being able to write out of the money. So within FEPI, on average, we've written 5 to 10% out of the money, which is relatively unique within this space. 10%. And again, you're capped, but you're capped on a monthly basis, right? So that could be 120% if we were able to write 10% out of the money every single month and the underlying stocks went up. Now, that's an ideal scenario, right? But you're still able to participate in that growth, which keeps NAV stable to keep those distributions stable.
Let's talk about overall market environment. What kind of market environment does a strategy like this really thrive in versus where it may have a little bit of a struggle?
There are a couple of standard market environments where you have expected performance outcomes from covered call strategies generally, which FEPI falls into, right? If markets are going gangbusters, to your earlier point, you're going to have good absolute return because you're going to be collecting the premium and you're going to be participating up to your strikes. You're going to underperform relative to an uncovered index that you track. But you're still going to have good performance. So that's a relative conversation. If markets are kind of on a moderate upswing where they're rising again up to those strikes or up to and around the strikes, then you're participating in all of the upside plus the premium. So that's sort of the ideal scenario for these types of strategies. If markets roll that month after month after month, you're performing incredibly well and you're likely starting to outperform the underlying index. In choppy markets or kind of more sideways, you're collecting the premium, you're taking advantage of the volatility within the underlying names, and perhaps the underlying index is flat in that environment, and FEPI at that point would be benefiting from the premiums again. So those are kind of three standard performance periods.
Yeah, and investors know that too well, right? It's very hard to time the market, as we are all fully aware of. Thank you for breaking that down. Really appreciate it. Now, FEPI is this ETF with AUM of over 500 million as of while we're recording, and it's a recent kind of ETF on the market, about 2 years old now. So, with a limited kind of track record so far, what should investors be thinking about with? Okay, yes, it is a newer fund, and actually covered calls in general, as you were talking about earlier. Like they were only maybe a decade old now. Like you're looking at this newer kind of income stream strategy in place. What should investors be thinking about was like, okay, yes, this ETF may be new, but there might be potential.
Yeah, no, I mean, it's a great question, right? FEPI is going to have a 2-year track record here in just over 1 month, right? So it's October 2023 is when we launched. Very proud of the $500 million that we've been able to raise in the strategy. And I think what we've accomplished is exactly what we set out to do. So I would explain two primary proof statements to address those concerns and make people comfortable with how we're managing the strategy. So the first one would be more drawdown environments, right? And so in those 2 years, we've had two meaningful tech sell-offs. So the first was July, August of 2024. Then the second is probably the one to highlight here is what we experienced earlier this year, right? So if you look at February 18th to April 8th, FEPI was down 23%. So I've talked about volatility within the underlying names. It's what drives premiums. In covered call strategies, you are exposed to the downside, right? That is a fact. What you do realize, though, is the uncovered version, so the Selective FANG and Innovation Index was down 29% in that same period. So you do have some protection on the downside in the sense of the accumulating premium to the tune of 6% in that case. Now, the second piece of that equation is the out of the moneyness. So like I mentioned, if we're writing 5 to 10% out of the money, that gives us potential to rally in those environments. Also, in sell-off environments, implied volatility typically spikes, so you have the ability to capture more premium and or write further out of the money. So in the following 2.5 months, so from April 8th to June 26th, FEPI was up 31.1%, which is, in my opinion, incredibly impressive to be able to get to pre-sell-off levels in 2.5 months in what you would describe as a capped strategy. So out of the moneyness is incredibly important on the upside. Higher premiums is incredibly important on the downside and also on the upside for total return. The second piece, kind of proof statement for that is around the premiums that we've generated, right? I have conversations with advisors probably every single day where they are saying 25%, you have my attention. How are you doing it? What kind of leverage do you have in the strategy? And I always start off by just saying, look, there are a lot of covered call options out there right now. We probably have one of, if not the most simplistic strategy. In FEPI, we are equally weighted 15 US big tech stocks, names that you and your clients know. We write 100% on each of those names. It's the beauty of the ETF wrapper. You can look at our daily holding file. You see exactly what we own, and based on the index methodology, right? So very simplistic. The way that we're capturing and distributing that high of a distribution rate is exclusively from the premium, and we actually collect more in premium than we distribute. So on average, we've distributed 2.1% per month, but we've collected 2.64% in premium on average each month. So we have over 50 basis points in excess premium that's going directly in NAV to help bolster and sustain NAV over the long term. So those are kind of the two proof statements I think that investors should really kind of focus in on, is those drawdown environments and ability to recover, and the idea that we are not paying out of NAV and we're actually collecting additional premium to help bolster that.
That's brilliant. Got to say that's brilliant. Now you mentioned the index as well, this Lactive Fang Innovation Index, which is an equal weighted index, correct? So why equal weighted over a market cap weighted index for this strategy?
Yeah, so I think that really just comes down to the idea that the tech sector in general is just highly concentrated. And I also mentioned earlier, high volatility, right? And so equal weighted is really just the best way for us to capture risk premium within that space. Whereby we would otherwise have highly concentrated exposures to a couple of names with an already concentrated portfolio of 15. So it's a way for us to balance risk premia across the portfolio. And it's essentially as simple as that.
All right. So let's go into the fund states no K1 for the distribution, right? So
Mhm.
obviously a lot of investors, specifically here on Seeking Alpha, I know it happens in webinars all the time. People talk about K1 or is this not K1? So when you're talking about K1 tax implications, why might this be favorable to not have a K1 for this ETF on the distributions?
Yeah. So, point number one in every client conversation is how do you do the high distribution rate? Point number two is taxes and what does that mean for my clients? Um, Return of capital is a really interesting concept within, and it's unique. It's unique to a couple of different asset classes within the ETF structure. Covered call happened to be one of the biggest beneficiaries, and I'll use the term tax feature in this sense. So return of capital can come across as being, more aligned with what I'll call NAV erosion, where people believe I give you $100, you start paying me $2 back, and now I'm taxed. And in reality, that's not the way that this works. So return of capital is really a tax classification, right? And return of capital is determined by an equation that's really the ETF's distribution minus the ETF's net income. And if you think about an ETF's net income, it consists of realized capital gains, dividends, interest, minus the expense ratio. We're talking about a portfolio of 15 big tech stocks. Dividends across the portfolio in aggregate are maybe 50 bips. Interest is negligible. We set money aside on a monthly basis for the distribution. Realized capital gains are a piece that can materialize, both gains and losses from the rebalancing. So we're trimming positions and adding to positions on a monthly basis. So that is a potential. But when you have a distribution rate of 25%, it's very difficult for the ETF's net income to exceed that. So return of capital is a likely outcome in that sense. Now, what return of capital actually means and what it does for clients is where it gets really interesting. And essentially, any distributions deemed return of capital are going to be tax deferred in that year. And instead, your cost basis will be reduced by the dollar amount of distributions deemed return of capital.
Yeah, a lot of good points there. Thank you. Taylor, before we wrap up here, obviously we've been going for quite a while. Just wanted to ask you about this specific ETF, right? The ETF landscape, the market overall, right? I'm pretty sure I saw the headline the other day. There's more ETFs now than there are individual stocks. More and more covered call ETFs, more people going to ETFs to look for that yield coming in for them and all the different strategies there. Hence why we have this show to try to dive into them and help educate the strategies. But how do you see this fund kind of staying ahead of the rest of the pack with all of this competition going on out there?
Yeah. I kind of got distracted for a second because I love that whole stat that there's more ETFs than stocks, because I think I saw a counterpoint. There's more words than letters in the alphabet, right? And I think in that context, you all of a sudden start to think, wow, okay, that makes sense, but all of these different solutions can be used in different ways for individual client goals, right? So I always tell clients, look at all the other covered call strategies out there, because they're different use cases for how people should approach using these types of strategies, right? I mean, if a portfolio of 15 tech stocks is going to be incredibly valuable to certain people and potentially too risky to others, moving forward, I often have a conversation with people about, over the last 2-3 years, if you felt like valuations were too rich and you thought spend on AI was not going to actually come to fruition in terms of the benefits of that, you missed out on a lot of return within that space. And I think that trend continues. And if it's a way for you to kind of get your feet into the water there, where you have, exposure to tech, you're able to pull some of those returns from the future in terms of through the premiums, then this can be a really interesting way. So if you look at the historical monthly volatility of FEPI relative to the Selective FANG and Innovation Index, it's about 1 or 2/3 of the volatility of that overall portfolio. So it's a lower beta approach to the tech space. It's a way to meaningfully enhance income within the portfolio. I think from a broader ETF perspective, what's beautiful about having an index methodology like this, where the Selective FANG and Innovation Index is really picking the largest and most liquid US tech names, is that by design is going to adapt and evolve with that underlying tech market.
Yeah, solid point. Actually, I was just looking at the holdings as well, and I think Intel is your current largest holding. So it's not even just the newer names, right? There's legacy players that people are focused on in the tech space right now. So everyone, thank you so much. Taylor Ranney, Senior Vice President over there at Rex Financial. This has been about the FEPI ETF. Go check it out here on Seek and Alpha. Add it to your watch list, maybe even your portfolio if you think it makes sense for you. Obviously, it's for you and all the tax implications things. Go talk to a tax advisor as well. I will mention that. But everybody, this has been another great conversation. This has been another episode of ETF Spotlight, and we will see you again here next week with another episode. Take care.